Happy Friday, guys. And I met up yesterday again with Matt Piepenburg, an absolute expert in bond markets, equity markets, precious metals, and where the market is really going. So it was a fantastic conversation. I was on location. He was over in Germany, I think. And he goes through a masterclass in understanding where things are going in the world of financial pensions, debt, everything else, and really useful information to get an overview of everything that's happening and what's most likely coming. We also discuss precious metals, of course, and the link is down below. I sometimes mention to Pure Gold in London if you want to follow up with other experts in similar matters and get a full consultation. But anyway, here we go. Matt Piepenburg.
I've interviewed Matt a couple of times already. He's partner with Von Greyerz, I believe. But Matt, you can maybe give a brief history and clarify the pronunciation of that.
Yeah, even I screw it up sometimes. Von Greyerz AG, we're based out of Zurich. We're founded by Egon von Greyerz, who started this company well over 20 plus years now, almost 25 years, really as a kind of a gold sanctuary for himself and a small circle of friends when he came out of a long history of banking and running a FTSE 100 company. Certainly very familiar with, he was a vice chairman of a FTSE 100 company out of the UK, Dixon's, which was the largest, electronics retailer. He had done very well. And he saw the writing on the wall about debt and the unsustainability of currencies and massive risks in banking and certainly geopolitical risk, even 25, 30 years ago. He was buying gold at $300 an ounce and not for the price appreciation. Of course, now that price has gone up 10x, but his whole entire thesis then as now was wealth preservation, protecting the purchasing power of your fiat money, which was a beautiful ice cube melting slowly over time through debt policies and unsustainable debt levels. And sovereign governments' reaction would be to debase their currency to monetize those debts. And I get, you got to give credit. He's not a gold bug. Egon was again a banker and a Wall Street guy or a market guy, but he understood basic history. He understood legacy protection for his family, and he understood gold not as a kook asset, but as insurance for dying fiat money. And that was 3 decades ago. And you fast forward today, we were the largest gold kind of service provider and vault private gold provider outside of the commercial banking system for high net worth clients in the world. And the thesis is very simple. Don't hold your gold in paper form in an ETF. Don't store it in a commercial bank. Understand currency risk, understand historical and political risk. And if you understand that, you'll understand you have to insure your fiat money with some asset that actually holds the test of time and stores its value. And again, he bought it at 300. It's at well over 3,000. But he's like me. We're all agnostic about the daily price moves. We really just know that gold holds its purchasing power better than paper money. And since he started this for himself and a small circle of friends, we now have clients in 90 countries. And we have some pretty cool vaults and it's kind of hidden in the Swiss Alps with the safest vault in the world. We have another one in Singapore and one in Zurich. So what was a deep personal understanding of financial and banking risk and what was a very personal investment for Egon has become an enterprise with, like I said, clients all over the world. And of course, now gold is making the headlines for all kinds of reasons, but this is something Egon has known for decades and the rest of us have picked up. And I've certainly have figured out in the last 10 years and couldn't be happier having the kind of conviction we have right now in this asset. It's just for so many reasons falling into place, but really no surprise to any of us, probably many of your listeners as well.
Excellent, Matt. Yeah. And before we get into the lunacy of what's going on in the markets at the moment and where it's likely heading,
Sure.
just a real quickie. Of course, you and you always or often mention it, you have a background in bond trading and equities trading. You went through the crazy times decades
Sure.
ago. So it's
Yep.
not like you're gold all the way. You migrated or evolved into what you just described.
Yeah, it really is. And again, I totally understand skepticism. There's a lot of crazy in the gold space. There's certainly a lot of crazy on the alternative media in the gold space, a lot of fear, a lot of gloom and doom. But, as you indicated, I came up in the late 90s almost as I like to say, an accidental tourist into markets. I was a lawyer for about 10 minutes. I had a very wealthy friend. We started a hedge fund sourced by his parents. I was trading the NASDAQ at the time. We won a lottery ticket on an IPO. It was like the Bitcoin trade at the time. It was just ridiculous. There were pre-IPOs in the late 90s during the dot-com bubble. we were just going long short a market that was all long until it wasn't. But we got very, very lucky. And then that was in 98, 99, 2000. By 2003, 2004, we had a family office with some of those winnings, and we collected those monies with other families and then into a multifamily office. And that's when the real education began, where I was allocating myself and other people's money into the smartest guys in the room, whether that was in New York, Chicago, London, Asia. We were allocating large sums of money, and I got to get a real good education, more than the lucky trader I was during the tech era, and more as a smart allocator and an executive at a family office, to the best and the brightest and some of the worst. You see the good, the bad, and the ugly when you're allocating. But I really got my education, certainly going long and short credit and equity during the dot-com. That was fairly a fat pitch because it was a rising tide. You just had to look at the bond market to see the risk signals. But my real home was always the credit markets. To me, the bond market is everything. That's where I'm most comfortable. I still to this day track the bond markets to understand the equity markets and even to understand currency and hence gold markets. But to me, the bond market is everything. Debt is the key issue because every crisis in the markets, every crisis in American markets, European markets, modern, historical, going back throughout the history of capital markets to the first Persian trading huts, every crisis is a debt crisis. A debt crisis is a credit crisis. A credit crisis is a bond crisis. And every bond crisis is a liquidity crisis. And every market crisis, whether it's the Nikkei in 89, the NASDAQ in 2001, the S&P in 87, 88, 87, and certainly the great financial crisis of '08, whatever market you're looking at, whatever time you're looking at, it's always a liquidity crisis, a grotesque mismatch between the amount of debt you have, which is extraordinary and irrational, and the amount of income you have. And of course, the modern solution since the 18th century in France, or you go back to ancient Rome to today, is you fill that delta with money that's synthetic, that's literally debased. You create fake money. QE is the obvious example, but the French tried it in the 1780s. The Dutch did it, certainly the John Law era of 1720. And of course, QE, modern monetary theory, it's all just the same lipstick on the same pig. It's just fake liquidity to solve the debt crisis, which is self-inflicted, usually because of spending beyond your means to stay elected or to stay in power, or going into direct or indirect wars too far outside of your delta zone or your zip code, and just creating massive amounts of debt. And the US today and Europe and the rest of the world is really no different. It is a debt crisis. And so, long answer to your question, whether I was looking at credits, whether it was junk bonds, whether I was looking at sovereign bonds, whether I was looking at corporate bonds, I was always looking at the yields. I was always looking at the cost of debt. I was always looking at who was buying that debt or who was not buying that debt. Because once you stop having buyers of your debt, you have a liquidity crisis. And what we just saw, whether it was the tariff headlines or not, the Liberation Day announcement and losing 10 trillion on the markets in 2 trading days, was just another liquidity crisis. And again, this is all symptomatic of a world over its skis in debt, led by the US, of course. But that ripple effect of US debt or liquidity problems affects everyone. Tariff policies affect everyone. Geopolitics affect everyone. But it's all of us are really the dog being wagged by the tail of sovereign governments, including the US in particular, that are criminally mismanaging their bond markets, their credit markets, because they've criminally mismanaged their debt, their sovereign debt. And when I came into the markets as a kind of a young idiot, lucky idiot with a lottery ticket in the NASDAQ in the late 90s during the first dot-com bubble, and going through the great financials of 2008 and certainly what's happened since, I've just learned that you got to look at the bond market, you got to look at the cost of debt, and everything is a liquidity crisis. And ultimately, when there's a liquidity crisis, you inflate your way out of that by debasing your currency. So to your point, I evolved into precious metals as a way to protect that currency debasement. I evolved into precious metals not as a gold bug, but very much like Egan, as a credit guy, as a bond guy, and as a trader in those, and then also as an allocator in those assets. And to me, what is obvious to me is what I've just explained, a debt crisis that is now morphed into a currency and market crisis, for which gold is an antidote, an obvious antidote long term, and not a gold bug trade, not a gold bug fear and gloom and doom narrative. Although, of course, gold always makes the headlines when things are in chaos. And so the gloom and doom is not a sales technique or a narrative. It is a reality that more and more of us are starting to figure out, but which, again, Egon, myself, and others learned about years ago. We saw the writing on the wall. And I'll tell you, many of the guys I knew on Wall Street who were long short arbitraging credits and equities using derivatives, however they were making their money in their portfolios or with their hedge funds when they were taking their 2 and 20, which was easy to do when the tide is rising. You're getting 20% of other people's money's, returns. However sophisticated or unsophisticated they were, off the record, after dinner, having drinks, it was gold discussions even then, because we knew that this QE, this sustaining or monetizing the bond market with literally mouse click money at the Fed or at the ECB or the Bank of England or the Bank of Japan was a completely unsustainable fiction. And, again, it all comes from understanding the bond market and understanding the cracks in that bond market and understanding the quote unquote solutions to those cracks, which is just artificial money, which is currency debasing money. Once you see that, you realize you have a currency crisis, and gold holds its value far better than those beautiful ice cubes that we call the dollar, the franc, the euro, the peso, the yuan. Obviously, the dollar on a relative basis can be stronger than other currencies, but even that's getting weaker because the debt levels have become so irrational, so criminal, so undisclosed, really, and undiscussed, whether it was Yellen or Bessent, Biden or Trump, or whoever came before. It's just been a Ponzi scheme of living beyond our means, spending beyond our means, and then trying to solve that with money that's not coming from tax receipts or GDP or production or actual income, and then blaming that problem on the rest of the world once the bill comes due, which is what Trump is doing right now. So it's a fascinating time to be watching the history and the math of these markets. Ivor, it's crazy.
It is crazy. It's an
Mm.
absolute mess.
Yeah.
And you know what? I'm so delighted I found people like yourself and the Mavericks organization, etc., back in 2020. So obviously everything went crazy then. And
Mhm.
it made me look a bit at macroeconomics and global geopolitics. And luckily, I moved a lot into physical gold back then because it was becoming so apparent what you describe. But
Yep.
now the markets, many people would be interested. Well, we can't predict. You got to watch the price action and you got to be aware of everything that's going on. But the
Yeah.
markets now are in a downward channel that seems predominantly bearish. They may get a dead cat bounce in the coming weeks. But I interviewed Simon Hunt the other day, and I've been
Mhm.
in contact with the usual
Mhm.
well informed people. And generally, there's a broad consensus, not like on Masks Save Your Granny, but a proper consensus that we're probably heading towards the end of this year into a pretty severe down on
Mhm.
the S&P, etc. Not
Mhm.
guaranteed.
Mhm.
And anything that happens in the coming weeks is probably dead cat bounce. And kind of amusingly, I got out a couple of years ago, a little bit like Buffett, not comparing, but I got
Mhm.
out a little too early. And I
Mhm.
watched the indices of my pension prime funds going up over 40% from when I
Yeah.
got out. I said,
Mhm.
okay. But I moved a lot into gold, so I was fully hedged.
Mhm.
But now they're around 16% up from when I got out. So
Mhm.
I'm wondering, is it possible they'll go below 0% of when I got out a couple of years ago?
Look, it's a very important question, and people always assume that if you're a gold bug, you're just perma bearish and perma cynical. I'm agnostic. Sometimes when I follow a trend, I'll see the trend as your friend. I'm still in my DNA a speculator from my first days as a hedge fund guy to a family office guy, even as a gold guy. And I've been very open when I've been risk on. I was risk on all of last year, only because the Fed had given such a fat pitch towards the end. As we came into 2024, there was so much galvanic talk about Powell cutting rates after trying to beat inflation with higher rates, which he failed at, and we can talk about. But the Fed was basically telegraphing rate cuts for 2024. So it was a clear and wide open fat pitch for me to go risk on. Not because I thought the markets were fair value, not because I thought the PE ratios or price to book ratios or any fundamentals that I would normally study made any sense, but only because the markets are Pavlovian. When the Fed is dovish, it's usually risk on. When the Fed is hawkish, it's usually risk off. That's how sad and this tragic free market price discovery or so-called capitalism really is. Because really, certainly since patient zero, I think well before Bernanke and Yellen and Powell, really Greenspan was just pro Wall Street. What the Fed does is where the markets go. That's not capitalism. That's Wall Street socialism. When you get low rates or money printing, markets are going to go up. When you get QT instead of QE and higher rates, markets are going to puke. So 2024, I was actually very bullish, not because I liked it. I had to plug my nose and go long because it was very obvious. When I came into 2025, very, very different, not just because of the Trump effect in the recent election, but I knew that the Fed was running out of credibility. I knew that the markets had become dangerously narrow, just like they were during that dot-com bubble where young idiots like me in their late 20s could go long on anything with a dot-com and make money in an IPO. But by the end of 2024, going to 2025, you've got such a narrow market and an overvalued market that even the greatest guys that I allocated to, Jeremy Grantham at GMO, Gunlack on the bond market, Druckenmiller, Paul Tudor Jones. So it's not just gold bugs. We all saw this was a too narrow, overvalued market. And to your point, Buffett, my goodness, the Buffett indicator is, market cap to GDP. And for we were at 2x. So the markets were 2x GDP. The only time we've seen that in recent history was 1929 and during the Nikkei crisis in Japan in 89. So it wasn't just that the grotesquely overvalued nature of the S&P was now screaming risk off. Buffett himself was hundreds of billions of dollars in cash by 2025. So it wasn't being a gold bug, gloom and doom, always negative on the markets. I can be up or down depending on the signals, but the signals in 2025, unlike 2024, were risk off. And look at a place like California where four tech names are 10% of its tax receipts, or when Nvidia was 12% of US GDP. We saw that during the dot-com bubble. I saw that with Lucent. I saw that with Qualcomm. I saw that with Commerce One, a pre-IPO that I got into. I saw that with Microsoft. They weren't necessarily companies. Lucent, Microsoft, Commerce One was a zero gamer, but a lot of these companies weren't bad companies. They were just grossly overvalued. The Fabulous Seven, the Super Three, the Fabulous Five, whatever you narrow them down to, aren't necessarily companies that are going to fail, but they were grotesquely overvalued and their net income margins were unsustainable. So to your point, I would rather get out early than too late. You got out a little early. I was a little more bullish last year. This year, I'm completely bearish because the market itself is screaming overvaluation on a technical and fundamental basis. It's screaming overvaluation. When you see also an inverted yield curve, which gets wonky into the credit, when you see an inverted yield curve reinvert, and then you see the yield in the 2-year spiking, again, looking at the credit markets, those are usually precursors for insiders to know it's time to get risk off. And the only thing that would change my opinion about that is if we see bazooka money from the Fed or we see dramatic cuts in rates. I think the Fed will only throw in bazooka money when you see a 20, 30% correction in the markets. So, I think a lot of the people I talk to and a lot of the signals that I'm looking at, again, not just me, you can look at the best and the brightest in the risk asset spaces. They share our views. And if you don't trust those guys, certainly Warren Buffett, who's kind of the oracle of Omaha, who certainly understands value investing, isn't seeing value in this markets. He's taking money to cash. So there's so many indicators, Ira, that this is an overvalued market. Can I time it? Absolutely not. Can it go up? Art Laffer had a cigar in his mouth. He sees the S&P going to 8,000. I don't. But, you know, if that were to happen, that would be even more of a spike before a crash that we saw in 29. But now, again, a narrow market, an overvalued market, the smartest guys in the room are pulling out. I think that's my view that this is not going to be an easy year. And we saw what happened with the Trump effect, certainly with the tariffs and Liberation Day, and we saw those massive pukings in the markets right away, and then a sudden recovery. Um, Believe me, that was an interesting indicator. Maybe your viewers get this or don't get this. Why did Trump initiate these harsh tariffs, certainly against China, but also against Canada and the EU and the UK, and then change his mind after a few days and offer this 90-day pause, which got the markets galvanic again. Again, markets trade like Pavlovian dogs on headlines and dovish indicators. The Trump scare was now over. He was pulling back a little bit on the rest of the world. And so now it's risk on. But actually, when you see those type of intraday moves, that's actually a very dangerous sign that markets are topping. And more importantly, I don't think Trump decided to put a pause on the tariffs to the UK and to the EU and other countries, ex-China, because he wanted to do a better negotiation. I think the real signal and what we just went through a couple of weeks ago, where the VIX went to 60 and the yields went to 4.5 on the 10-year, which means no one was buying Uncle Sam's treasuries. And the dollar actually went down. The DXI went down as yields were going up. That never is supposed to happen. There's a lot of reasons we get into, but the real panic for Bessent and Trump a couple of weeks ago was when they announced those tariffs, there were treasury auctions the next day. Again, this is bond market boring stuff. Treasury auctions, those are Uncle Sam's IOUs. We live on debt. If no one buys our IOUs, we have to print money to buy them. What happened the day after the tariffs, which never made the Wall Street Journal, never made the New York Times, which I don't even read anymore. But what happened after that announcement of Liberation Day is no one showed up at the treasury auctions. Usually the primary dealers, the banks and the central banks buy about 18% of our bonds same day. The next day was about 1.5%. It was crickets. And if no one buys our bonds, I don't want to get into the bond conversation, but if no one buys our bonds, the bond prices go down. And if bond prices go down, the yields go up. And when yields go up, that is like rising rates. That's cost of debt gets higher. That's crippling to an economy, to a market, and certainly to a country in debt up to its ears. That was when Bessent must have gone into Trump's office and said, whoa, we bit off more than we could chew with these tariffs. We got to pull back on some of these announcements. The market needs good news. And it was really the credit market, again, the bond market, which was the signal that we can't even fight a tariff war. It was the kind of cojones that we thought we could. Just like Powell couldn't fight inflation by raising rates because Uncle Sam can't afford his own rising yields. That means the cost of our own bar tab gets too expensive. So the bond market is still the thing. We're talking about tariffs and Trump and all these other things, which are very relevant. But the real problem, the real cannonball on the ankle of Uncle Sam and anybody who's in office, left or right, smart or stupid, half asleep or totally crazy, genius or fool, Papa Smurf or Santa Claus, whoever comes into that White House or that U.S. Treasury Department or that Federal Reserve Eccles building is completely in the corner now. There are very few options, very few tools left to them. If they raise rates to fight inflation, markets tank. Worst markets we saw since 1871, excuse me, in 2022. Or banks fail like they did in 2023 because bond prices tank. Or during the tariff attack or so-called announcement, our yields spiked and no one was buying our treasuries. So the Fed and Powell and everyone else are trapped because the debt is too high. Whenever they make a move, bond markets start to sell off, yields start to rise. And if your viewers want to take anything away without having to come bond gooky, rising yields are like shark fins swimming alone in the ocean with blood in the water. You don't want to see shark fins coming, and you don't want to see yields rising because that cost of debt, those rising yields equal the cost of debt. And when you have a country like America, the home of the world reserve currency and the 10-year treasury, in debt up to its ears, and its costs of debt get higher, things go wrong everywhere. And it certainly affects the world. And so that was really the indicator to me that they're trapped either way. We're in a corner. And when you're in a corner as a country, just like a corporation or a family or an individual, you tend to do desperate things. You have little to lose. And you start doing desperate things like trying to fight China in an open tariff war, or trying to do an intentional disruption of the entire global system, or trying to make a strategic Bitcoin reserve to save our debt crisis. And, there's just crazy things happening. And we can talk about each of those. On the other side, you have optically good things happening, like Doge, trying to cut spending by 2 trillion in the next 2 years, or looking at US aid and discovering how corrupt it is and how much wasted money. Great. But as I've said many times, cutting the spending by 2 trillion or optically going after US aid, all better than anything Biden tried to do, by the way. But that is a guppy solution to a whale of a problem, because we are going to fiscal spend our way to the moon, and eventually we're going to bazooka money our way to the moon to save these markets, to buy these bonds. And when that fails, after just absolutely insane currency debasement to do that, when that fails, we'll roll out the IMF's plan of a global reset, central bank digital currency, more centralization, more good news, really masquerading as really centralized control, which gets into a whole other topic. But we are in a debt corner as a country and as a globe, and we're being led by a world reserve currency that no one trusts the same way and no one loves the same way since 2022. And so everything is upside down right now. Everything is upside down. And even when the markets start to really tank, that's when the things get really scary. And that's when the desperation gets even more crazy. But I don't know where I got off track there, but Trump tried to puff his chest, tried to do some hard negotiations, tried to do something um, policy induced chaos or policy induced chest puffing, but it backfired right away. And we can talk about how those things could play out, but the real signal that he didn't have the power or the weapons or the tools or the sword thought he had was his own bond market started to puke and yields started to rise. And so again, everything comes back to debt and everything comes back to credit and bond markets and yields, boring stuff, which again, your readers don't or your viewers don't have to become experts in bond yields, inverted curves, interest rate swaps, the basis trade, all these wonky Wall Street fancy terms that we get lost in. What they have to understand is when a country like the US or the European Union or the Bank of England in England is completely in debt, it has very few tools left. And when the cost of their debt becomes higher and their central banks have to solve that by printing money, that's a crisis. And they have no choice because if no one buys their debt, then the entire engine stops because debt is paid for by fake money or real money. And when that's the grease, and if the real money runs out, then the only other grease they have is fake money, which is printed money or mouse clicked money. And that is currency debasing. And the whole world sees that coming. The markets see it coming. The BRICS see it coming. They've seen it coming for years. And that's why they're buying physical gold instead of US treasuries or US dollars.
Well, absolutely, Matt. And it's just kind of a form of bedlam, and it really is a great thing if you could see some of it coming and get into some physical gold. Now that has paid off maybe better than it normally would have. Gold would have been a great purchase a few years ago when I moved family pension into it, etc. But the way it's going now with the central banks buying it still at very high rates,
Yep.
like this is the question that's come up is a correction in gold. Now, Simon Hunt said, yeah, sure. I said, look, could it drop to 25, 2,700? He says, yeah, that's around the level it could drop. But
Mhm.
but with the central banks amassing like never before, is the kind of normal correction of gold to make a new base and then go on up to huge heights as they print, mouse click money, as you say.
Mhm.
Long-term gold is perfect in every way,
Yep.
but a correction can maybe disturb people. But I wonder, will a correction happen like it did in the past, perhaps in this new world? It's
Mhm.
very different now. What are your thoughts on potential correction and long-term value of gold over the multiple years into the future?
It's obviously the question on a lot of people's mind, and it's a perfectly rational question, and it deserves a rational answer. And I have to always caveat by saying, "Oh, here comes Piepenburg. Of course, he's going to say gold never goes down, only goes in a straight line. He's an executive in Zurich. He's going to be pushing his book." And okay, I get all that, but let's get past that for a second, if it's possible, because it is something I've been giving a lot of thought about. Because I too am an investor of gold. If I see a big pullback coming, I would wait too to keep buying more gold. And again, when gold just a few years ago was at 1,600, and I was on Kitco, and they asked, "Where do you think it's going?" I said, "It's going significantly higher. It could go twice as high." Well, that meant $3,200 gold. That seemed like a blasphemy. That seemed like selling your book. Again, the idea wasn't because I'm such a gold bug and I'm such a bookseller. What it is I just saw currency debasement getting worse. Now, they are very smart people, and I was just in Cape Town, South Africa for a few days with Heinrich Zieberg, a really nice guy I trust. I really love his views. We agree on just about everything, but he has been arguing, and we've had good discussion on this. Well, Matt, gold is great, and it's definitely going to go much, much higher, but not before it tanks significantly in the next market crisis. When there's another '08 moment, we saw gold lose 30% in 2008 and then skyrocket back up because when risk assets like stocks and bonds sell off, people have to to cover their losses. They have to sell their good assets to cover some of their losses. Gold is usually the first to be sold, and so you'll usually see gold sympathetic with a falling S&P. It too will go down and then spike back up. Okay, that's a very rational argument, and you can take that argument and you can look at it, and you should. Everyone should. There could be, if you believe that this S&P is looking for a mean reversion. By the way, Bloomberg, their analysts see the S&P overvalued. They see a real fair valuation closer to 4,000, and they are very negative on the markets. It's not just me, the gold guy in Zurich. So whether it's again Paul Tudor Jones, Grantham, GMO, Grundlach, Warren Buffett, or Matt Piepenburg, whatever, or Bloomberg, I see a mean reversion in these markets. So if the markets tank, and gold does what it did in '08. It should tank too, and it's a great buying opportunity. And I remember people calling me when gold was at 26, saying, I'm just going to wait for a pullback. Then it went to 28. I'm going to wait for a pullback. Then it went to 3,000, now 32, then 34, 35. So a lot of ways to answer this. The first thing is, if you're a gold investor rather than a gold trader, if you're looking 10 years out or 20 years out, as I always have, I don't care if I buy it at 34 or 32 or 26, because I think it's going to go significantly higher. If you're a trader, it's a very different conversation, because that's a very painful price swing. I mean, I've never seen gold move $100 in a day ever, and it did it 3 times in the last few weeks. That never happens. That's how dysfunctional things are. But let's get back to this argument that if the S&P or the equity markets tank, or we have a global recession, won't there be like an '08 sell-off in gold? That is a very rational argument. It could very well be the truth. There'll certainly be a small sell-off. A couple things I would say. First of all, just the last couple of weeks when we saw the markets puke and that Liberation Day volatility, everything went down, but the dollar went down. Obviously, the bond prices went down, stocks went down, but actually gold went up. Now, you can say it's just a few days, but the other thing that you have to keep in mind is 2008 and the great financial crisis and the puking on the S&P and the Nasdaq and the Dow and gold falling in 2008 is going to be very different than 2025 or 2026 when these markets start puking, because gold is in a very, very different place than 2008. And let's be clear, the signs are everywhere. So it's not just me making that up and saying that. You had the Bank of International Settlements make gold a tier one asset in 2023, right next to the U.S. Treasury, which is laughable because the U.S. Treasury doesn't even beat inflation. But the writing on the wall was gold is a better store of value. It's a better strategic reserve asset than the IOU from Uncle Sam, the world reserve currency. That should have been global headlines. Discuss the ramifications and implications of making gold a tier one asset is massive. The other thing you have to keep in mind is a year before, when we weaponized the dollar against Putin and the sanctions, whatever you think of that war, that was a massive blunder. When we weaponized a neutral reserve currency like the U.S. 10-year, and we actually stole the U.S. treasuries from Russia, that made the U.S. dollar and the U.S. 10-year less trustworthy to friends and enemies of the U.S. alike. I've said many times, if you keep your money at Bank of America and they seize your assets, you're not going to recommend that bank to your friends. When you froze the FX reserve of a major nuclear power, which was a trading partner with China, because of a geopolitical dispute, the world reacted by trusting that U.S. dollar and U.S. 10-year far less. So what happened? The BRICS got ignited. They started settling trades outside of the U.S. dollar and the U.S. 10-year. 45 countries traded outside of the U.S. dollar. 30 countries repatriated their gold into their own zip codes. These things are facts. I'm not making these up. Central banks, starting in 2022, had 118 tons of gold. By 2024, they had 290 tons annualized gold purchases, basically tripling their gold. Why? Because they suddenly wanted to make more earrings and jewelry or fillings for their teeth? No, because after we weaponized the neutral reserve currency of the world, people realized, I don't trust that dollar and that U.S. Treasury anymore the way I used to. And by the way, the issuer of that U.S. Treasury has now 37 trillion in debt, in public debt, 100 trillion in unfunded liabilities that it can't afford, and it's got a massive public and corporate debt level. So the issuer is bankrupt. It doesn't beat inflation. Oh, and by the way, they weaponized it as well. I don't trust it. All those things, tack onto that, the BIS making it a reserve asset. Then last year, you saw the COMEX losing gold. Gold's supposed to stay in the COMEX so they can churn and burn it to fix the price. Now countries or partners or others or players on the COMEX wanted their gold out of the COMEX. That's unheard of. That happened last year at record levels coming into this year. Won't get into the whole COMEX discussion. It's very wonky. It's a sign that gold is more trusted than the U.S. 10-year and the U.S. dollar. That's all I'm trying to say. And then, of course, you have the oil trade. 20% of global oil sold outside of the petrodollar. That was unthinkable 5 years ago before we weaponized the dollar. Now you've got UAE and Saudi Arabia talking to the BRICS about selling gold outside of the US dollar. All these things are a way of saying that the hockey puck is moving away from the US dollar. That is not a gold bug argument. That is fact. Those are things that are happening that are astronomical importance, massive importance, that are completely unspoken in the mainstream media, completely undiscussed by the politicians in Europe and the US. And yet everyone from the central bankers to the big whales who are buying gold with us or in the central banks see the writing on the wall. This is a seismic shift in the trust and role of the US dollar. Not the end of the dollar, not the end of America, but a completely new world
Mm.
in
Yeah.
which gold is absolutely, objectively, and quantifiably seen as a better strategic reserve asset than that once sacred US 10-year treasury and that once undeniably strong US dollar. And those things are not gold bug arguments. Those are the facts and the flow of money. You just have to watch them. You will never see that discussed objectively by Besant or by Lagarde or by Trump or by whoever is in charge in the country you live in. It's certainly not in Canada, where they're putting more and more ex-central bankers into positions of power. It's a grotesque game of insider criminals, in my opinion, mismanaging everything. But my point is only, unlike 2008, gold is now far, far more relevant and far, far more strategic. So if you, to your question, will gold retrace significantly? Not nearly in the way it did in '08, because gold is so much more embedded into the system now, so much more front run into protection before there's a crash than there was in 2008. And it's far, far more relevant as a global strategic reserve asset than it was in 2008. What's happened to gold since '08 is undeniably historical.
Yeah.
That's not a gold bug argument. That's a fact. That doesn't mean, Ivor, that gold only goes in a straight line. But even the IMF in 2020, during the absolute COVID hysteria, which was a whole other conversation, but even during that absurd moment in human history, the IMF and Christina Georgieva, almost in a cartoon-like way, went onto their website and created this thing called the New Bretton Woods. You can literally go to the IMF's website and type in the New Bretton Woods, and it's there. It's a video where they blame the whole world's problems on COVID instead of themselves. And then they talk about this new central bank digital currency to come. But even that new central bank digital currency, to have any credibility, they said in 2020, would have to be in some way correlated to physical gold. So whether it's the IMF, the BIS, of which I am no fan, believe me, or the central banks of the world buying gold, all of these things, or the BRICS moving away from the dollar, or the petrodollar change slowly but surely moving away from the petrodollar, those are all objective facts that are screaming indicators that gold is far more relevant today than it was in 2008. So when there is a puking in the markets and a mean reversion in the markets, gold will not probably tank like it did in '08. It could have a retracement, but it will certainly skyrocket higher. And to your viewers who are interested in gold, please, I'm talking to only one type of gold investor, which is an investor. And your time horizon has to be longer than this quarter or this month. If you want to trade gold or go long and short futures or play contango in the futures market and get in and out of silver and gold in the short term to get rich, I'm the last person to talk to, because that's not how I look at gold. There are people who do it. Very few people do it well. To be honest, I've seen very few people do it well. But if you're an investor in gold and you're thinking about insuring against the dying ice cube of your dollar bill or your Canadian or Australian dollar or your euro or your Swiss franc, if you're thinking intelligently, commonsensically, and historically and mathematically about the next 10, 20 years, and if you have children at all, of course you should be buying gold. And whether you buy it at 26, 28, 35, or $4,500, believe me, 10, 15 years from now, well, I think, should never say believe me, but I think it's going to be significantly higher than 4,500, 5,000. Egon, I joke, well, you can make it 10,000, 20,000, but when you revalue gold to 20,000 or 10,000, which I'm quite confident it'll be in our lifetimes, and certainly in our children's lifetimes, and I'm certainly sure that that 1 ounce coin you have will buy a heck of a lot more than any dollar equivalent today, 20 years from now. You've got to be thinking longer term. And yes, of course, Egon, I said, bought it at 300. It's well past 3,000. He's 10x his return. By the way, far better than the markets would have done for the same period. But even Egon, who made a fortune on this, never says, I'm so smart because I got it at 300. Now it's at 33 or 3,400. No, that was never his intention, price optionality. It was about, I know that 30 or 40 or 50 years from now, whatever gold I have will buy me more than the dollar I had then. It's just that simple. And for people who understand that, it gets way past gold bugging, gloom and dooming, speculation nonsense. It gets to common sense. Your paper money is never going to be as valuable or buy as much for you over the long term than a simple gold, physical gold ownership. However you want to hold it, just don't hold it in an ETF form, because that's not the same, and don't hold it in a commercial bank. They have a long history of losing it or not having it there when you need it, or freezing it when you want it. So Again, what was Egon thinking 25, 30 years ago? I just want to have physical gold outside the banking system in my control, totally in my name, segregated, allocated. It's mine. And I'll save in gold and I'll spend in Swiss francs or euros or dollars when I need it, which is exactly what the central banks of the world are doing now. They're trying to, and they're acquiring gold like drunken sailors, trying to bring it in, trying to get more gold so they can save in that. And then when they need to buy or spend, they'll convert it to their local currencies. And that's what smart investors have been doing for centuries. And that's all we're doing at Von Greyerz. That's all your viewers need to do too. They don't have to become clients of Von Greyerz. We have very high minimums. It's a very different world for many people, but anyone can own physical gold and save in gold. It is not, oh, I'm going to try and get rich. If you want to try and get rich, go along Nvidia or Bitcoin, play that trade. We can talk about that. But
Well,
if you're trying to stay rich, it's gold.
absolutely, Matt. No, there's a superb summary there. And like for me, it's central. I mean, I had very strong conviction back in 2020 and through 21, 22, always checking with the best in the business, including yourself and Hunt and everyone else, always integrating all of the best kind of experts
Mhm.
to get my own kind of conviction. But
Mhm.
at this stage, for me, it's, and pardon the pun, it's central. I mean,
Yep.
if the central banks are piling up, and another point that was made, it could have been Jeff on Eurodollar University or one of the other good
Mhm.
guys.
Very good
It
guy.
could have been Mike Maloney actually, that the
Mhm.
massive purchases recently that have driven the price up are all central banks, private equity, and they're the big guys.
Yeah.
So the retail is not driving the price up. The retail, the
Yep.
people that, in fairness, Maloney always wanted to get the middle class, the ordinary people protected in the
Yep.
ways we're talking about by getting into gold and getting out of the monopoly money. But
Yep.
the irony is still, it's
Yep.
the big guys who are getting in, which should tell people,
Yeah.
something big. Don't let them
Mhm.
walk away with this.
Uh,
Hedge
it's
somewhat.
it's incredibly frustrating. And you
Mm,
may say hypocritical because at Von Greyer's, we only represent ultra high net worths, family offices, institutional money, very, very wealthy clients, very good people, very far-sighted people. But Egon and I have always said we can that's how our operations work. That's where our clientele is. When we go on interviews, we write articles for everybody. I'm from the lower middle class of the US. I had to come through scholarships through school, work my way like a lot of good people. Those are the heroes. Those are the backbone of every culture, as Walt Whitman said. The backbone of any nation is its middle class. I always speak to the middle class, even if I've been among the upper class, whether as a hedge fund guy or a family office guy or a gold guy. And even as an individual, I'm now in that higher percentage. I have never forgotten that I come from the Midwest, that I had no money, and that I had to work really hard. And I had to find my own education outside of just fancy schools. I had to teach myself about how to take care of myself financially. What bothers me so much right now, to your point, is yes, it is the whales that are surrounding this market right now. And what's even more egregious and deliberate is how the mainstream media, that massive pile of dog whatever, can say nothing, talks, it's crickets when it comes to gold. Again, crickets. Gold at all-time highs. Gold at 3,400 would have been massive headlines, you'd think 3 or 4 years ago. Now it's what's amazing is the silence. And I can go into a lot of the reasons why, but gold is very embarrassing to bankrupt countries and to bankrupt systems and to insider systems. They don't want the retail investor to understand gold. Hell, they don't want even Harvard MBAs to understand gold. They don't want your private wealth management, Goldman Sachs or UBS, to understand gold truly. They don't want you to understand gold for a lot of reasons. But what is so criminal and so obvious and so intentional is the deliberate omission of the discussion of gold in the headlines today with everything else,
mm,
all the nonsense that passes as information. It is very deliberate. I wrote a whole article months back about what's killing America. It was basically that five companies own our entire media. That's it. In the 80s, there were 50 companies. That's a whole other discussion. But the lies of omission are the most important lies. It's what they're not talking about, what they're
mm.
not telling the mainstream investors. So that's very sad. So the average retail person, good trusting person, clicks onto their left or right media and gets their information on everything, isn't being told about gold at all. And
And
then, and the other crime is they trust that these people will give them the right information. But the other sad crime is, and I'll end there, is a lot of these people, even if they do understand it, Ivor, they don't have the money to buy gold anyway, even a couple grams. Many think there's so many are just struggling to get through the month. But even if they finally get it, they feel like they're too late. And I really respect that. When 20% of Americans, their entire salary goes to their rent. So they have to get a second job just to pay for groceries and gas. So it's very easy to tell them, look, I'm one of you. I came from the lower middle class. You can do this. But yeah, Matt, you don't know. Tuition, rent, mortgages, health insurance. I don't even know if my job's going to be there next month. I can't get an ounce of gold at 3,500 or 3,400 or 2,800. So
I
it's that.
Yeah, and that one I thought about that quite a while back when I linked up with Pure Gold. Obviously, they're much lower minimums. They're more for average
Mhm.
people, if you will.
Yep.
But I thought about that and I figured at the end of the day, anyone who is against the blob, shall we
Yep.
say, we won't get into conspiracy, but anyone who's
Yep.
against everything we're talking about and all the big players and the whales,
Mhm.
there'll be a bunch of us on that side of the more decent, ordinary people who
Mhm.
will be able to hedge,
Mhm.
and by hedging themselves, protecting themselves, will be able to help other people more in the future. So I just
Mhm.
see it as
Yep.
a virtuous circle that the more people who are decent people, like
Mhm.
ourselves, I might say, the more people who understand this and hedge and do
Mhm.
what the bad guys, if you will, are doing,
Yep.
the better
Mhm.
for all of the ordinary people, even if there are many who can't get there. But
Yep.
in many cases, pension funds, and this is what I did, I took my pension fund and it took a bit of work and got
Mhm.
it created so it could invest in physical gold.
Yes. Yes.
I didn't have a whole lot of money to invest, but I was able to
Mhm.
translate the pension. That's working out
Yes.
beautifully for me. But you
Yes.
know what? I want to be respectful of your time, and you've covered so much already, Matt. I
Mhm.
saw a clip with you the other day, just to switch gears to
Mhm.
Bitcoin. And the
Yep.
Bitcoin maxis who follow me, they always get
Mhm.
annoyed when I'm not hyper positive on Bitcoin.
Yep.
But you did a world class 4.5 minutes. Myself and my wife watched. I'm not sure which show you're on. And you just revealed what you'd learned about Bitcoin as a
Yeah.
reserve and what was really going on. So if you could reproduce that, I'd be
Yeah.
delighted.
Look, it's certain, and I know because you have to run the risk of really upsetting the true Bitcoin true
Yeah.
believers, and I really do want to be conscious of that. And by the way, I'll also say it. I'll say it again. There are two brothers at a site called the Black Swan Capitalists who I've interviewed with. These guys have spent they've they've done the homework. They really have. They're agnostic about pro gold, pro Bitcoin. They're just looking at the data, and they happen to understand both very, very well. And I recommend anyone to just look at these two brothers, the Black Swan capitalists. But to your point about Bitcoin, like I said, I've been trying to figure this out for so many years, the paradoxes of Bitcoin, really. And look, I also wrote an article about the U.S. Constitution being a museum piece because our Article 1, Section 8 and 10 of the U.S. Constitution say the U.S. money should be backed by gold and silver because in the 1780s, the founding fathers said, if you don't have a gold chaperone, you're going to go into debt, you're going to create more money, you're going to ruin the country. So they actually predicted 250 years ago what's happening right now. But at least the Constitution, which we lost the gold backed security officially in 1971, but when every politician or central banker or congressman goes and puts their hand on a Bible and pledges allegiance to this Constitution to serve the people, they should at least be serving the U.S. dollar, the currency of their country. So I was trying to figure out why on earth would a sovereign nation like the U.S., when the president puts his hand on the Bible or the Constitution and swears allegiance to that Constitution, why would they create a strategic reserve for a crypto asset whose entire narrative is anti-fiat, anti-dollar? Why would a country create an anti-dollar strategic reserve? So that paradox, and why was Trump or Larry Fink, who now has a $50 billion crypto Bitcoin ETF, who just a few years ago said it was a fraud and he didn't trust it? So why would Larry Fink or Donald Trump want to have a strategic Bitcoin reserve? It just didn't make sense. So I had to try and put the dots together. And a lot of people, Luke Groman, the Bear Son, these folks at the Black Swan Capitalists who kind of done the homework, kind of put it into perspective. There's a couple things. First of all, Trump calls Bitcoin the new oil. There's a great book called A Year at War by this guy named Sheikh Yaswami or Yaswami, A Year at War. And it talks about America in the 1970s was looking down the barrel of a lot of debt from the Vietnam War. So they had to create an asset that was dollar tied, and they had to inflate that asset to create demand for dollars to get themselves out of the debt they were in. And literally in that book, they talk about this is not a conspiracy theory. The Kissinger and his group came out to the OPEC countries and said, look, we're going to inflate oil by 400% to get more demand for the dollar to pay down our debt. And that's what's going to happen. And that's what we're going to do. And that actually happened. That is not a cartoon conspiracy theory. So, what is the new oil? Bitcoin is the new oil. There's a couple things. Bitcoin, right? Then you create a bubble in Tether. Tether is a whole treasuries, then actually the country coin, you hype it up, you pump it up, and then you use that to create demand for Tether asset bubble. They use those winnings to pay down some debt. So you could say that America is as desperate as El Salvador, like a third world country. We're going to pump up a bubble, take its winnings, and pay down debt. So we're going to artificially inflate this asset. But it gets even more kind of nefarious than that. It gets even more obvious why the US would pump up an anti-dollar strategic reserve because it actually creates demand like oil for the dollar. And if you look at the Loomis bill under the headlines, you'll see that the way the Loomis bill works is the biggest liquid trading pair for Bitcoin is the US dollar. If you create a Bitcoin exchange where you can only enter it through US dollars or US stable coins, then basically by inflating Bitcoin, you're sucking in demand for the US dollar. You're using Bitcoin, this so-called maverick anti-dollar apolitical decentralized crypto that's supposed to be against the dollar. You're actually using it to create demand for the dollar. In addition, if you create on those exchanges a requirement that those exchanges hold a certain percentage of US treasuries, again, you're using Bitcoin as the carrot to bring demand in for US treasuries and US dollars. So that is fascinating. That explains why you could be the president of the United States and take an anti-dollar asset, speculation asset, and make that tied to the US dollar. The ironies abound because it makes the Bitcoin narrative of being apolitical, decentralized, and maverick completely upside down. And then when you look at companies like Ripple, we're full of NSA kind of spooky alumni who created this ISO compliant blockchain technology back in 2001, 8 years before Bitcoin came into fruition magically by some stranger who knows who that is. Very important question, whole other rabbit hole. But if you created this digital level this DLT technology back in 2001 to token the eventual tokenization of all things, whether that be intrabank transfers, smart contracts, meme coins. If you create that technology in 2001 and then you roll out Bitcoin in 2009, and then 70% of the Bitcoin holders are eerily static. We don't know who they are, but they never buy or sell. They just hold. I don't know any asset class in the world where anyone just holds through that kind of volatility unless they're part of a larger plan. That's my view. But this thing that the Black Swan capitalist guys understand is the link between Ripple, the blockchain technology, the eventual birth of Bitcoin, and the use of the tokenization of all things, which will eventually be the programmable, trackable centralization of all things for all of us suckers to buy into because we'll no longer be anonymous. That's a whole other thing. But if you look at the daisy chain and the chronology of the ISO compliant blockchain technology and the Ripple alumni of 2001, the birth of Bitcoin in 2009, and now the use of a Bitcoin strategic reserve to create demand, ironically, for the dollar in an anti-dollar asset class, you start to see how it all comes together. Now, for many Bitcoin people, they can be agnostic. Well, that may be true or may be a complete foolish thing, Matt. You and the Black Swan capitalists don't understand. Michael Saylor is a genius. Satoshi Nakamoto was a genius. We know something you don't, because a lot of the Bitcoin crowd use the exact same narrative of gold as gold does in terms of debt crisis, sovereign currency crisis. They're absolutely right on track with most of us gold guys. I know a lot of Bitcoin guys like Larry Lepard, or even an author of the In Gold We Trust report, Ronnie Sturfula. His fund will speculate in crypto and Bitcoin and talk logically about it because you can plug your nose and still love Bitcoin, even though its narrative is completely bogus as a decentralized, maverick, apolitical asset. It's entirely centralized and political. But if this Loomis bill passes and we make a strategic Bitcoin reserve and we use Bitcoin as the carrot to bring in money to buy US dollars and US treasuries indirectly, it can go long. Much will hinge upon whether this Loomis bill passes. That's an executive order is not the same thing as this thing actually becoming reality. But if it does, certainly Bitcoin will go up. Plug your nose, front run the trade. It is not a store of value. It is not digital gold, though. It is a politicized tool. It is an intentionally created weapon against your private civil liberties, as well as a intentionally created asset bubble to ironically magnetize more demand for the US dollar, which is otherwise unloved and increasingly unloved. So it's a very, very interesting deeper dive into how all these moving parts come together. But for many Bitcoin people, all they see is it's anti-government, it's anti-bank, it's anti-politics, like Voorhees. That's what he said. Pound my fist. I don't know much about everything, but I know Bitcoin is decentralized, apolitical, and it's outside the banking system, and I can transfer 5 million like that. All of which is true, but none of it's saying the whole story. And I think that's what people need to at least investigate more. And again, the folks at Black Swan Capitalists have done nothing but investigate this. They're miles ahead of you and I in understanding this. And I think to your point, we're not going to change the world. We're not even going to stop central bank digital currency. We're not. These programmable, trackable weapons of mass destruction masquerading as more efficient and transparent money transfers are coming. But to your point, every platform that discusses this and shares this at least opens it for discussion, gives people a chance to at least look a little deeper and understand a little bit more what's really happening. Even if we're impotent, maybe to change things, but if it's a ripple effect. If we can get more people to look a little deeper, it takes more than one interview or one quick synopsis of the Bitcoin trade. But if we look at it more carefully, we can get more educated, more informed. And again, Bitcoin is many things, but even Scott Bessent said this just 2 days ago. He said Bitcoin is a risk-on trade. It's a speculation trade. And I agree. And I actually agree with Scott on that. And gold is a very different asset. And that's why the central banks of the world are stacking gold and not Bitcoin. And Bitcoin can still be very relevant. I'm not making fun of anyone who goes long Bitcoin. But with a standard deviation in triple digits and at least 4 maximum drawdowns of 80%, and it is clearly a speculation asset. It also has the highest annualized return in the history of capital markets because in 2013 it was up 5,000%. You cannot compete with the annualized numbers of Bitcoin. But as a guy who allocates money, if I looked at an annualized return of 60%, I'd be super excited. But if I look at their maximum drawdowns of 80% or more, 4 times in a row, and I look at their standard deviation of triple digits, that is a screaming sign that it is a risk asset. It is a speculation asset. It is not a store of value because a store of value doesn't lose its value by 80% over and over and over again. And it doesn't go up $1,000 or $10,000 in a day. But that doesn't mean it's stupid to invest in it as long as you understand it is a speculation asset. And if it becomes a politicized speculation asset, go long all day long. Just stop calling it digital gold. Stop comparing it to gold. Stop calling it a store of value. That's all I have to say. That's it.
Ex- and excellently said, Matt. Yeah, I mean, for me as an engineer and a hardcore tech guy, I can't get away from the fact that it doesn't really exist. I mean, it's just
I
a
know.
principle thing. But also,
Yeah.
we saw across Europe, and we're going to wrap up now. I really wanted you to tell that story, and it's
Mhm.
going to liven up the comments below, of course. That's
Yeah,
good.
I
The
know. I
conversation is
know.
great.
I'm an
But
idiot. Yeah.
Europe, we had pictures of massive queues at ATMs, and we got
Mhm.
to see what green energy really means, which is
Mhm.
frequency instability in the grid and could shut
Yep.
down half a continent.
Mhm.
And B, we got to see what happens all your bitcoins and your paper money and your digital currencies when there's a
Mhm.
problem with the power supply alone.
Yep.
So for me, at the end of the day, physical gold all the way, and
Mhm.
play with Bitcoin, speculate if you wish. I don't use
Mhm.
it for crossing borders and
Mhm.
what it can do,
Sure.
but it all comes back to physical gold as the bedrock, the anchor,
Mhm.
and which at the end of the day, if all the bad guys, in my mind, the bad guys, are
Mhm.
getting in hard,
Mhm.
that kind of gives you the answer, right?
I mean, look, it is true, and it's an analog asset, not digital. It's old, it's a pet rock, blah blah blah. But it's ironically far safer to have that pet rock under your bed or in a vault or outside of the banking system than it is to have a digital wallet of Bitcoin. Again, that's going to infuriate half the Bitcoin crowd, and they're going to say you know nothing, and they could be right. But look at the Black Swan capitalists; they know more. But again, Ray Dalio said, I'll own gold and sprinkle a little Bitcoin on top. The speculator part of me looks at it. And believe me, if this Loomis bill passes, I wish I had bought Bitcoin a long time early because if it passes, it's gonna spike. I've known a lot of people who've got in and out of Bitcoin at the wrong time and have had a lot of stomach churning pain. And I've never seen that with gold investors, but it's a very different mindset. So I'm not trying to insult Bitcoin people or Bitcoin speculators. I'm trying to warn them it is not the same store of value. It doesn't mean you can't make a ton of money. I've had so many clients make a fortune in Bitcoin who talked to me in Zurich and said, I'm now converting it to real money, to gold. And they knew what it was, and they were honest about what it was. It was a speculation asset, and they wrote it. Good for them. My IPO in the dot-com bubble had no moral or substantive value, and I had no problem with making money out of it, but I never called it a smart trade. It was a fat pitch. It was that time. So I'm not mocking the Bitcoin crowd. I asked them to question or at least explain a little bit more when it was created, who created, why created it, and how do you explain its standard deviation? The answer, it's just consolidating or it's part of Metcalfe's law, isn't good enough for me. That doesn't mean it can't go much higher. But by the way, when you see JP Morgan or BlackRock now as the custodians for GLD and SLV for ETF gold and silver, these are the foxes guarding the henhouse. I mean, JP Morgan, the bad guys, they had over a $900 billion fine for price fixing and manipulating the silver price. And now they're in charge of guarding silver at the SLV ETF. So again, it's not like gold is full of all kinds of good guys either. But again, this is why Egon said 25, 30 years ago, I do not want to hold my wealth, my precious metals, my reserve saving asset with one of those banks, which we're all alumni of. We all worked at them too. So that's what's kind of funny. We've got bankers, ex-bankers working in gold right now. And we have a lot of clients who are current bankers who don't want their gold in these banks. So again, whether it's your group, smaller group, retail guys, it's very important. You don't have to have high minimums and buy gold in Switzerland and put it in some fancy vault. Every one of us, and even Egon says, can buy a milligram or an ounce if we can. And we can hold it, whether it's in a Folgers can under our bed or in a safe deposit box or with some undisclosed friend. Just be very careful, obviously, about who you talk to about with it and who knows you have it and where you keep it. But own their physical gold. Absolutely. And yes, it's boring. It will not have the price moves of certain risk assets, including crypto, but it will give you the peace of mind, regardless of its price fluctuations. Longer term, it is a far better store of value than any other asset out there. That to me is an objective fact. And that's up to each person to decide if that's important or not.
That's bottom line stuff. And I'll just clarify for, well, perhaps not needed for yourself, but for anyone watching. When I say, quote, bad guys, I mean Goldman Sachs. I mean the top banking families way up the top, not high net worth individuals.
No,
Who are
exactly.
smart. Yeah, no, I mean the
the
big
JP
boys.
Morgans. JP Morgan, the guys who are the custodians of your ETF metals.
There you are. Well,
that
look,
is absolutely crazy.
We'll hope for a happy day where all the good guys who either went the gold route or the Bitcoin route all clink glasses, and ultimately we win against the genuine bad guys.
Yes, absolutely.
Everyone's happy. I mean, there's the vision.
Yes, I like it. And I'm very happy. And I wish I had bought Bitcoin a lot cheaper. I wish I had the guts to hold on to it a lot longer. Again, I'm not calling this crowd stupid. I just want to be clear on what the parameters are, what the risks are, and certainly even the opportunities in Bitcoin. Really, if this Loomis bill passes in particular, and believe the day I can pay my taxes with Bitcoin or do real, medium of exchange with Bitcoin, I'll change my tone completely.
Yeah.
And,
for me, what it is it's just like, especially since 2020, it's be cynical, be very cynical. You don't want to be paranoid, but rather than have confirmation bias, and for instance, Bitcoiners who hear you mention the capitalist crew, what they should do is go and check them out.
Yeah, just check them out.
Because instinctively, what we often do is we don't really want to go and dig in areas that are against our bias and our beliefs. But of course, you should always go first to the places that are apparently providing data that's against your beliefs, because you always seek to break your own hypothesis. Anyway, I don't want to wax lyrical here and critical thinking, but you got to break your own hypothesis. And if you can't, it's good.
Totally
Happy
agree.
days.
Totally agree. And those poor guys at Black Swan are being attacked as being XRP shrills because they're saying XRP is part of this blockchain protocol. They're not. If you listen to them carefully, just like you are not just pumping gold and I'm not just a gold bugger, it's much more to it. And I agree that I'd be cynical too. You gotta, I try all the time and I find ways to question gold. I look at the things that can scare me about gold. I look at it all the time.
Same
and the
here.
moment I lose faith in gold, I'll be the first, and so will Egon. We'll be the first to say it. If we see something where gold looks dangerous, we'll say it out loud. But the price moves have nothing to do with our daily thinking. Don't even look at it. Literally, don't even look at it.
It's long-term 10K or whatever it ends up. It's a long-term thing for your family's wealth for the future. If you want to speculate, just like you said, I don't do any speculation. I'll dollar cost average at most. not a speculator, and I don't think most listeners are at all in
Yep,
speculation. It's about long-term protection, I think.
exactly.
But here,
Exactly.
Matt,
Yeah.
fantastic as always, and I
Yeah.
believe fantastic weather. And you were out building some stuff in the sun. You got a bit pink.
Yeah, I'm the wanker polo guy now that I'm gone from the bottom to the top, so to speak. No, I'm out building a little horse barn. So I got some serious sun. We've had 2 weeks of rain, so we finally had some sun here. So I'm red faced, like you're going to be after this interview. A lot of
Oh,
sun.
I am, because I'm looking straight into the sun, and I can feel it. I
Oh
can feel
yeah,
it coming. But you know what?
yeah.
I'm pretty brown already. I get sun every chance I get, and I have 4 kilowatts of sun lamps that I invested in a few years ago because sun is health.
Oh, it
Um,
is. It
so
is.
I got my sun callus, shall we say?
Yeah, no, we're basically in the same continent right now. I mean, Europe. So we're all enjoying this good weather right now. It gives us a little something else to think about besides the crazy world and markets. So enjoy it.
Hey,
Enjoy the outdoors. Yeah.
exactamundo. Thank you so much, Matt.
My pleasure, as always. Look forward to the next time.
Absolutely.
That'll do it, folks. Always love to talk to Matt. He's just so well informed, incredible expertise. And as I mentioned, I have a followers deal. If you want to follow up with a free consultation with Pure Gold in London, I believe they're the best. And as I mentioned, I've made sure my family's pension and other kind of wealth, such as it is, has been made safe and hedged by owning precious metals. We also discussed how markets do correct. It's hard to trace exactly where things are going in the next couple of months, but over the long term, in the years to come, most of the, or in fact, all of the top people I perceive as the best in the business of finance are all pretty aligned on the longer term value of gold going up and up and up. And hence, that's why all the central banks have absolutely piled in. As we said, the bad guys know what's coming. So anyway, link is down below for a period of free storage and of course the all important consultation. No financial advice, completely up to you. But for those of you who are interested, like I did, in looking into these matters further and taking action, well, the link is there. Good luck.